When you start a business, there's numerous ways to do that. You've heard the term LLC or an S corporation or sole proprietorship or even partnership, and you want to determine what's going to be best for you. I'm going to give you some information, but I'm not an attorney. I have information on this program by both a CPA and an attorney. They'll talk more about that. The CPA and attorney have different perspectives, but even the attorney says, go with what your CPA says, because ultimately the biggest protection you need to worry about is taxes. The legal standpoint of protecting yourself and assets, your corporation is not really about stuff. It's about hurting someone in our profession. That comes down to good liability insurance. But talk to your CPA first, then talk to your business attorney, determine what you want to be. But I'm going to give you some insights from my perspective on what works best. So one of the first types and the easiest type and most common business type is what's the sole proprietorship. And sole proprietor is very simple licensing, very simple. It's just you, simple business, and off you go. If you are a sole proprietorship, at least make sure you have a separate checking accounts, one for business, one for personal, separate credit card, one for business, one for personal, and separate them from that standpoint. But there are no protections and there's no tax savings by being a sole proprietor. I will tell you this, talking to people in the know, that the number one most audited group of business types by the IRS is sole proprietorships. If you're a sole proprietorship, you're probably going to get audited many more times, more often than you would if you were an S corporation, for example. So be aware that the type of entity you are has an effect on a number of things as far as tax savings, but also, besides legal, also IRS audits. One more thing about sole proprietorships is understand that the owner is personally responsible and liable, that all the ownership comes to you personally, and there's no protections at all other than any insurance that you might purchase. The next entity type is a C corporation. A C corporation is like a large company like Ford or Chevrolet or a big company, and that really is like a person when it comes to taxation standpoint. The IRS sees that corporation as a great protection for the people under it, so the people who work for it are protected by that corporate covering, but it's taxed as a person. So if you have a company that has a profit margin and that company is taxed, now you have this much money left over on the profit, then you pay yourself out of that profit and you're taxed again. Corporations, a C corporation is taxed twice. From a state standpoint, from a licensing standpoint, your state sees all corporations the same. Same crisis for your taxation from a standpoint of licensing, all that is the same. They don't care. But the IRS determines different types of corporations. So a C corporation is a person, essentially, it's taxed, then you pay the employees, which would be yourself or your employee of your own corporation, and you're taxed again. So if you have a C corporation, it's the worst from a standpoint of massage therapy. You'd be double taxed. An S corporation, I'm biased, is my personal favorite. It's my CPA's personal favorite, and what that does is it gives you the benefits of protection of a corporation, but at the end of the year, in a blink of an eye, all the profits of that corporation go into your name. They're taxed on the profits, and then it goes back into the company. It's a simplified version, but the idea is you're taxed once. So your S corporation gives you protections of a corporation, protects you from liability and such, but it also taxes you just one time on your personal tax return. So I like it best, and something else about this is important to understand. I'm hoping the IRS doesn't see this, but I'm going to give you some inside information. The IRS requires you to pay yourself, you have to pay Social Security tax for your companies, right? So you have a company and you work for a company, you're an employee, and the company pays half your Social Security tax, and you yourself pay half of your Social Security tax. Well, when you own the company, we really refer to it as self-employment tax, because you're paying both sides of that. It's about 15.3%, somewhere in there, right? So you're paying both halves of that on your salary, on your personal money you make from a payment of your work that you do. When you have a company, though, you have stock in your company. So when you see people who own a company, they have stock in that as a corporation, but they also have a paycheck as an employee, but the stock is also earning value. So I want to keep this as simple as possible. The nice thing about being an S corporation is that I pay myself a wage, but I also earn money off of my stock in my company. Although I still have to pay income tax on that profit, I don't pay Social Security payments on that income from my stock. Now, here's the benefit, is that when you have a corporation, you pay just the Social Security on your salary, on your income standpoint, but not on the profit from your stock. And the government has never said, the IRS has never ever said what a reasonable wage is. You're supposed to pay yourself a reasonable wage. There's never been any court proceeding ever saying what reasonable wages are from the IRS standpoint. So if you paid yourself, if $100,000 come in and you have $50,000 in salary and $50,000 in shareholder distributions, profit off of your stock, when you pay yourself that, although you'll pay your income tax on everything, you don't pay Social Security on that $50,000. So 15.3% of $50,000, it's about $7,500. You're saving yourself a chunk of change on that money. So be aware that by having an S corporation, you truly can save yourself money by not paying yourself 100% in salary. But again, ask your CPA. They'll explain it to you. If your CPA does not believe S corporation is a good idea, they think, oh, that doesn't work, find a new CPA, because they're not up on how the system works and they're being more cautious than they should be. And their caution is costing you money. The next type of organization is an LLC, or a limited liability corporation. It's growing in popularity. It shields liability as well as works well for partnerships. So if you do want to have multiple people, LLCs are okay. It's difficult to get the tax benefits of the S corporation. It's not impossible. So again, talk to your CPA, tell them what you want to do. Tell them you want to benefit by paying yourself partly in shareholder distributions and partly in salary, and make sure you discuss that before you start your company. It's not impossible, but it's more of a pain to change it later. So please have that discussion with your CPA and your attorney. But once you choose what you want to be, you're going to create bylaws. And to be a corporation and have that stand up in court, so something horrible happened at your company and the company was sued by someone, your insurance is going to help you. But if that insurance isn't enough, or if someone wants to go after the company for additional money, that corporation protects you personally from that financial burden. However, a good attorney will go after that corporate veil, and they'll find out, are you handling your corporation the way you legally should? To handle it properly, there's several things you have to do. One is you have to have bylaws, and you want to start writing those bylaws right away. There's software you can buy to do that, but you also have to have a number of other things. You have to have shareholder meetings and those kinds of things. So your attorney will help you with that. You can go online and see all the different aspects of what you have to have, like a board of directors and such. But you also can be every person on that board of directors. You also can be president, vice president, secretary, treasurer. You can be all those positions all by yourself and still be a corporation. But make sure you dot your I's properly, and you go through and you have your meetings, like your bylaws, and you have to actually issue stock certificates, which is pretty simple. You have to maintain your shareholder records. You have to have regular shareholder meetings, which means once a year you sit down with yourself and say, how'd it go? What's the future going to look like? And just make some notes. And it's very simple when you have a small company that's just you, but you still have to technically do those things. And you want to record minutes for those, and you want to make sure that you do all those reports and file your annual reports with the state, and they'll send you those packets to make sure you fill them out. So I'm not really worried about that, but just make sure you take care of those small pieces so that someday, if there was a lawsuit, you're covered and protected by the ravages of some attorney who wants to come after you on behalf of their client. As with any business, multiple owners is so important for you guys to have an operating agreement. So that agreement controls what happens behind that corporate veil, so there's no arguing. It's so well written, and honestly, an attorney really should get involved in writing that operating agreement, because it can cost you everything if it's not written right. So if you want to have partners, if you want to go that far and have a partnership, please hire an attorney to write yourself up an operating agreement and make sure it's ironclad and very well done. As Steve Bean mentions in his segment on the law aspect of the operating agreement, things can happen like a divorce. Well, who gets to own the stock if a divorce happens? Is there an automatic option for the current members to buy the rest of it back? All those things can be taken care of, but you want to plan for the worst. And there's things like divorce, illness, death of somebody who's involved in that can really throw your business for a loop, and you want to make sure that's in there. but also duties. How do you handle distributions of money? Who gets to take money out of the account? I've seen companies that have partnerships, and one of the partnerships took all the money out. Nothing said they couldn't do it out of their operating agreement. They didn't even have an operating agreement. So they took all their cash out and went on vacation. And the rest of the partners said, wait, you can't do that. And he said, why not? It's not part of the agreement. So make sure that agreement has all the information in there.